Starting, all attendees are in listen-only mode.
Welcome. My name is Don Davis. I'm an editor at Digital Commerce 360, the e-commerce news and research organization. I'll be moderating today's webinar. We'll be talking today about cross-border e-commerce, which is one of my favorite topics because it's an area of great opportunity for online retailers, significant challenges, and it's changing rapidly. So this is the kind of thing that journalists really like. A lot to talk about. Our speakers today will be two experts on international e-commerce. Craig Reed is the Senior Vice President of International Trade at Avalara, a provider of tax software for online retailers and other organizations. And Eric Christensen, who's Vice President of Product in such areas, payments, fraud, and financial services for Digital Commerce, for Digital River, I'm sorry. Digital River facilitated something like $3 billion in payment transactions last year. Before we get started, a couple of housekeeping notes. First, there's a giveaway. Everybody on the call will be entered to the chance to win one of two $100 Amazon gift cards, and we'll be announcing the winners before we close in just under an hour. And also, everybody on the call will get a free copy of the 2021 Online Consumer Insights Report from Digital Commerce 360. So please keep an eye out for an email with that report. Secondly, I wanted to mention that we'll be taking questions at the end, but you can ask questions at any time using the chat box on the right side of your screen. And if you have any technical difficulties, you can also use that chat box to let us know when somebody will help you out. Okay, so let's get started. The main part of the webinar, as I said, is going to be a conversation with Craig Reed and Eric Christensen about cross-border e-commerce. But to set the stage, I want to provide some data and information about some of the things that are changing. And I'm going to turn my camera off now so we can focus on the slides. So as I said, there's a lot going on, and much of what I'm going to be talking about is based on research that Digital Commerce 360 and Avalara did for a white paper that's now available called Turning Browsers into Buyers. It's about international e-commerce, and everybody in the call will get an email with information about how you get a free download of that report. So please look for that as well. As we all know, online shopping increased dramatically during the pandemic, and that was true around the world, although there were significant variations. Internationally, online shopping increased by about 24% last year, but in the United States, it was up 44%. Ironically, in China, where the coronavirus pandemic is believed to have begun, they controlled it more quickly. Their stores were open sooner than in the United States, for example, and their increase was actually less than in most rest of the world. But pretty much everywhere, online shopping was up significantly, and that provides a big opportunity for online retailers to reach the world's many billions of online shoppers. And there's three main ways in which retailers do reach consumers in other countries: through online marketplaces, through country-specific e-commerce sites, and the main way, and probably the easiest, is accepting orders from consumers who arrive on your primary e-commerce site. Now, I'll focus on that, but first I want to just touch a little bit on marketplaces and country-specific e-commerce sites. So let's start with marketplaces. As you can see, more than half of the top 1,000 retailers that Digital Commerce 360 ranks, these are North America's leading retailers by online sales, and more than half of them sell on Amazon. About a sixth sell on eBay. Both Amazon and eBay have made it very easy for retailers that list on their sites in North America to also extend those listings to their marketplaces around the world, and many top 1,000 retailers and others take advantage of that. In addition, other major marketplace operators are encouraging international brands to sell on their platforms, and most notably, Alibaba's Tmall Global has attracted 25,000 brands from around the world to sell to the Chinese consumers there. Quite a few North American retailers sell on Alibaba's two main China-focused marketplaces, Taobao and Tmall. Only 5 sell on Mercado Libre, which is the leading online marketplace in Latin America, so that may be an opportunity. Some retailers do operate websites in other countries dedicated to those countries, 184 of the top 1,000. What's interesting to me is that these are, well, 30% of them are consumer brand manufacturers, and most of them are web-only retailers. But what's significant is that it's not just the biggest brands like Apple and Dell that sell internationally. It's a lot of online retailers and retail chains like Wayfair, JustFab, GameStop. And what that says is that it's not just a question of size. It's really about the willingness of companies to take on the challenges of cross-border e-commerce. If you are willing to do that, then you don't have to be Apple or Amazon to sell successfully around the world. And it's not just North American retailers that are selling internationally. Just recently, Marks and Spencer's, the big UK retailer, announced that it's going to expand its e-commerce operations into 46 new markets, so that'll be in 100 countries around the world. And they did that because in the past year, they saw that sales to overseas online shoppers increased by 75%. So big opportunities, and this is true for retailers of all kinds. Now, for those retailers who just wanted to get started, the easiest way to get started in cross-border e-commerce is simply to accept orders from consumers in other countries who come to your websites. And North American websites do get a lot of traffic from around the world, but even among the top 1,000 online retailers, which are relatively larger and mid-sized companies, only about half will sell to anybody in Europe. Less than half sell to consumers in the UK. About 45% to such potentially lucrative markets as Germany and Australia, and only 36% to China, which is the largest e-commerce market in the world. So there's a lot of opportunity that's being missed. Now, one of the things that we saw during the pandemic is that consumers obviously bought a lot more. Now they bought mainly a lot more domestically, as you can see on this charts on the left. More than 50% bought more from websites in their own country, and 2/3 of them expected to do more of that domestic online shopping. But on the right, you see that 32% bought more from websites outside of their own countries, and more than half plan to do more of that in the future. This is data comes from an annual survey by the International Post Corporation, which is a consortium of national postal services. Also wanted to point out a couple of insights from another survey conducted by ClearSale and Sapio Research of consumers in 5 countries. And as you can see that a lot of shoppers shop cross-border, but there's a big variation. And basically what we've found over the years is that consumers in countries like the United States, the United Kingdom, where there are a lot of major retailers that have big websites, and there's a lot of, you can buy a lot of stuff without going cross-border. The percentages who do shop internationally is lower. But in other countries where the domestic options aren't as great, the percentage are much higher. You see more than 72% in Mexico, more than half in Canada, 60% in Australia. So what we see also is that China is the leading country in terms of cross-border sales, rather Chinese retailers. So it's big Chinese websites sell the most, and largely that's sites like Alibaba's AliExpress, which sells uh, mainly inexpensive goods from Chinese factories to consumers around the world. Um, and China's share actually declined slightly last year to 34% from 36%. Germany's went up. The United Kingdom and the United States were basically flat. Not surprisingly, Amazon is the most popular retailer among cross-border online shoppers, followed by Alibaba. eBay is on the list. Wish is a US-based company that basically sells Chinese goods, and Zalando is a big German retailer of apparel and shoes and other items. Now, the main reason why people buy cross-border is price, but it's not the only one. A lot of times people buy because they can't find, they buy products in other countries that they can't find in their own markets. But one thing that's very interesting is that in some countries, particularly, consumers are going cross-border because they don't trust the domestic producers. And this is particularly true in countries like China and India, where there are large, growing middle classes, a lot of consumers with disposable income, but they don't necessarily trust the quality of goods produced at home. And so they go cross-border looking for better, more products that they can trust more than their own domestic products. Next slide. Now, there's a lot of things that are changing, and one thing that is new this year is starting July 1, the European Union is going to start imposing a value-added tax, what we in the United States call sales tax, on all e-commerce imports. So up till now, in most EU countries, a package that was coming in that was valued at less than 22 euros, about $25, would not be subject to VAT, but it will be as of July 1. And so the International Post Corporation survey recognizing this asked consumers, would they pay, how much would their purchasing from China be impacted by if they had to pay half a euro, 1 euro, 2 euros. And as you can see, even at relatively small amounts, European consumers say that they likely would purchase less from China. So this could mean less purchases from China over once these rules come into effect. A couple of insights from the ClearSale survey I thought was interesting. One is that online shoppers who spend more tend to be more confident in shopping internationally, and that's makes sense when you think about it, because more affluent consumers typically have been buying online more. They're more confident in general shopping online, and would also be more confident shopping websites in other countries. Another finding was that younger consumers are also considerably more confident than older consumers. And again, these are people who've grown up with the internet and tend to be comfortable with online shopping. But it's important to note, because these are consumers who are going to be buying for a long time. You win their loyalty now. It could last you for, these could be consumers that could be your customers for many years. And another point from the IPC study has to do with custom duties. So 15% of the consumers they surveyed in 40 countries said they paid customs duties on their most recent online purchase. About half of them paid at the point of purchase, which means that at checkout on the website, the retailer calculated the custom duties, told them what it would be, and collected at that point. Now that raises the price of the purchase, which can decrease conversion. But on the other hand, if you don't do that, the consumer could get a nasty surprise when he or she receives their packages and asks for to pay some more money to cover customs duties. So we'll talk more about this with Craig and Eric, but that's a real issue. With the other thing, just going back to that slide 1 minute, 10% of the people said they were dissatisfied with the experience of paying the way that the customs duties were handled, and 3% were very dissatisfied. So it points that there's probably an opportunity for doing this a little bit better. Okay, now we're going to move on to the our conference. Sorry, now we're going to move on to our conversation with Craig Reed of Avalara and Eric Christensen of Digital River. And I'm back on video. And Eric and Craig, if you would turn on your videos. Hi, Eric, Craig, welcome. Let's get started. By way of introduction, would each of you sort of tell us a little about yourselves, about what how your companies help retailers sell internationally via e-commerce? So, Craig, why don't you start?
Sure. Hello, everyone. Craig Reed. I'm the GM of our cross-border business at Avalara. I've been in the cross-border e-commerce business now for 21 years, which is hard for me to believe, but it's true. Starting with a company that some people may know called Borderfree, which started in Toronto back in 2000. Subsequent to that, I led the global e-commerce business at Pitney Bowes for 10 years. Left Pitney Bowes and started up my own business called TradeStream Technologies, which I then sold to Avalara almost 3 years ago, which is again hard to believe. So at Avalara, just to give you a sense, Avalara's got a long history of solving compliance problems for customers, and with cross-border, it's no different. So you can think of Avalara as really trying to solve the hardest compliance problems that you'll have as a cross-border retailer in getting into other countries. So that includes item classification, which we specialize in, duty and tax calculation, product restrictions screening, and we'll also be introducing a variety of different kinds of variance management tools coming up, and different types of, we also have different types of duty and tax engines depending on the application. So we have a full suite of products that allow customers to understand what their duty and tax implications are going to be, and remain compliant with their supply chain partners and governments around the world.
Thanks. Eric?
Hey everybody, Eric Christensen, Vice President of Product at Digital River. Not nearly as fun of a life cycle as Craig just described. I do have 20 years in e-commerce, but it's all been here at Digital River, all focused on the best ways to sell product around the world. So Digital River really helps our clients get to market quick, safe, and cost effective as they want to start to sell products around the world. We've got a pretty unique business model where we actually act as the merchant and seller of record on transactions, and then we'll provide all the payment processing, the tax management, the fraud protection, as well as any compliance management. We do this through a lot of different partnerships, including our partnership with Avalara, and use that to really allow companies to focus on what they need to focus on building products, and let us focus on the kind of the hard part behind the scenes of selling around the world.
Okay, so let's get to some of those hard parts. And one of the hard parts is getting your products through customs. So Craig, why don't you tell us a little bit about what are the things that retailers and brands need to know about restrictions that certain countries have about certain products, and also explain to us what harmonized codes are and what they mean, why it's important to understand how to operate effectively with those.
Sure, maybe I'll start with the last part of the question first, because it answers the first part of the question. So HS codes, most people, in the industry, we call them HS codes. They're basically the classification code that a country wants you to use when you're telling it what you're importing into the country. HS stands for harmonized system, and there is a 6-digit set of codes that all the members of the World Trade Organization have agreed to, up to 6 digits. What many people don't know, though, is that past 6 digits, so up to 10, some countries 11, some 12, are the codes that the country wants you to give them when you're importing a good. So it doesn't do you any good to have the first 6 digits if you're importing the same good into the United States or into China, into Canada, into the UK. Those are all different codes, and they all drive different duty rates depending on the country of origin as well. Also related to the classification codes are import restrictions, so different types of goods. So for example, leather goods into Italy, you can't import leather goods into Italy, and each country maintains its own import restrictions, and typically those are at the 10-digit level because they want to know what's coming into the country. They're potentially protecting domestic industries, or there's other reasons for it. So there's general import restrictions which are published at the import level, and then there's what are called OGA and PGA restrictions, which are other government agencies, you can think of it as, where it may be food and drug, it may be pharmaceutical, it may be medical. So that's another type of restriction. A third type of restriction, especially if you're exporting from the US, is scheduled ECCN, or controlled goods. Night scopes are a good example where you can't sell a night scope or sell it out of the US into other countries. So there's restrictions there. And then lastly are carrier restrictions. Some carriers don't want certain types of goods. Lithium batteries or concentrations of lithium batteries is a good example of that. So when you're selling cross-border, you need to take, depending on the types of goods you're selling, many of those things into account.
Yeah, and if you get the cross-border code wrong, I mean, what are some of the implications of that?
Well, a couple of things can happen. If you misdeclare the goods, they can get stuck in customs. If you misdeclare a value or you misdeclare the type of good, customs disagrees with you. It can get stuck or flagged in customs, which delays the shipment. That's usually the biggest problem with that. But apart from that, I guess that's really the biggest issue, is getting goods stuck in customs.
Well, but if you use like a generic code and not the specific code, can't you wind up getting a higher tariff than you would otherwise if you use the correct code?
Yeah, sorry. I was thinking you can have it corrected by your carriers. That's another thing that can happen, or your broker. So if you're importing in and your supply chain partner, for example, notices that you have the wrong code, they may put the right code on, and then when you get the bill, you're going to be billed maybe more than you anticipated you're going to get billed, or your customer, depending on how you do things. But yeah, you're right. That's the other big issue.
So, consumers are shopping on websites. They want to feel like the retailer understands their culture, their needs, which obviously vary from country to country. So, what do you advise retailers and brands that are expanding internationally in terms of how do they get the information they need to make consumers from around the world feel comfortable shopping on their site? So, Eric, would you want to start on that?
Yeah, I think understanding the consumer behavior in every country is super important. Obviously, what you just talked about, regardless of the rest of the customer experience, if you can't get the product in, you've got a really bad experience. But outside of that, assuming that you've figured out your HS code management and those types of things, understanding consumer buying behaviors, understanding local regulations really vary country to country, and understanding those is a big part of what you need to do. There's all kinds of resources out there that allow you to do that. Quick plug for the Avalara's got a really good website around information like that. Your payment partners will have a lot of information around how to properly process transactions online. So it's really digging in and doing a bunch of research yourself, or if you've got the wallet for it, bringing in an expensive consultant to try to figure it out for you.
Craig?
Yeah, I mean, from our perspective, it's really about setting expectations. I think, you know, a good customer experience is when things happen as expected. So obviously you want to set expectations around delivery time. That's one of the things that people are very concerned about. But then costs, you know, if you're shipping across borders and there are duty and import tax implications, then you should make your customers aware of that so that they aren't subject to costs that they're not aware of on delivery. So what we call DDP, or in the industry is called DDP, which is delivery duty paid, meaning that you're collecting the duties and taxes yourself. You're dealing with the duties and taxes on your end, and your customer pays at checkout rather than paying at the door. And even if, you know, there are situations where it can make sense to use DAP or DDU, where the customer pays at the door, but at least set the expectation of what they may be required to pay is, you know, a bare minimum.
And I think you hit on a good point there, Craig. And the earlier in that checkout experience that you can tell the customer what that's going to cost, the better, right? And letting them know,
Yeah.
you know, that those costs are there before they get surprised at the time the shipment comes in is key to a good experience. And earlier in that checkout experience will be better for understanding that for the customer.
Yeah, and when it goes, just add something out if I could. When it comes to localization, you know, there's things you can do with, particularly with duty, and I have seen customers do where they embed parts of the duty cost into the product price itself on product pages. So, you know, because I usually get the question, okay, well, what happens if they sticker shock at checkout? Aren't they going to abandon cart? And my usual first answer to that question is, well, you'd rather them abandon the cart than have a bad customer experience and be bad mouthing you in social media and leaving you bad feedback, number one. But you know, number two, if you can get a little more sophisticated and embed some of those costs into the product price, and or, you know, some customers to absorb some into margin because they know that their conversion is going to go up. So there's ways that you can kind of play with that. But at the end of the day, the customer's paying what they see at checkout.
I mean, it seems to me that a lot of the consumers who are buying, you know, prestige goods from foreign websites, they're pretty highly motivated, and you know, maybe building their price in isn't going to have that much impact. And certainly, as you say, it avoids the problem of unpleasant surprise when the carrier shows up and wants some more money.
Yeah, unpleasant surprises are never good from a customer, from a business, from a chargeback rate perspective. There's nothing good that comes from that.
Right, right. So governments, you know, have recognized that a lot more of their citizens are buying online from other countries, and they are getting more aggressive about taxing these imports. As I mentioned, the EU changes. Craig, can you talk about how these tax changes are affecting retailers and brands, and basically what they should do to minimize any problems?
Well, we're getting a tremendous amount of interest in what's happening in the UK, for example, where they've changed the tax import rules and actually made a difference between 135 pounds and over and 135 pounds and less in how you have to remit taxes. So, you know, what I see is just the pace of change has two things. One, governments are much more interested in collecting taxes in the first place now. And in a lot of cases, you know, back in the day when we were first starting in this business, governments weren't nearly as vigilant as they are now. Because of the volume crossing the borders, governments are very, very aware that if they're not collecting tax properly, there's a big hole in their P&L. And they're interested in getting those taxes, number one. Number two, you know, again, because of the volume and the influx of e-commerce goods, it's really also about, hey, making a level playing field for domestic retailers, so that, you know, if you're importing a good into the UK, for example, while your customers paying the same amount of VAT as they would be if they were paying for a retailer locally. What that means for a retailer, though, is just complexity. So, you know, with all the change that's going on, all the changes in tariffs, changes to de minimis rates, you know, the rate at which duty and tax can start being charged, the changes that are happening in the UK, soon to be in the EU, just means that you know, in our opinion, it just doesn't make sense for the average retailer to try and stay on top of that, because you want to be a retailer, you want to be selling, you don't want to become a global trade expert. That's not really a good use of resources. So, you know, that's again why we do what we do, is try to help customers remain compliant with all these changes, all these fast-paced changes, and just give them the information they require to do business, and then let them do business.
And these tax laws are not going to slow down, right? Every country is realizing quickly that they're letting money on the table. So while it's in the UK and it's coming to the EU, you'll see it in every country before we know it. So it's just going to get more complex before it gets easier.
So,
Yeah, I think, I mean, with all the money the governments have spent on the pandemic too, you can bet that any opportunity to collect sales tax will be taken advantage of.
Right. The level playing field, I think, is also a good point that you made, Craig. Like, merchants in country have been arguing for a long time that they're at a disadvantage from merchants that are selling outside the country, and so they get the pressure both from a revenue perspective and from their internal merchants to make these law changes. And so you just continue to see them happening. And I think, as Craig said, nobody wants to be a global tax expert except for us two guys on the call. So.
Anything specific to Brexit that you know, people on the call should know about in terms of what they have to be aware of?
Oh boy, Brexit. You know, we get so many questions about. There's just a lot of confusion in the marketplace, I guess I would say, and a lot of folks getting conflicting information, particularly for imports into the UK. We've seen had a lot of questions where folks have been given, you know, almost accurate information, but far enough off to cause a problem. So yeah, the specifics around the way the UK implemented their changes has a lot of folks scratching their heads and really having to make some changes to the way they do things if they don't have a way to do it kind of automatically. And then from our perspective, especially with trade between the EU and the UK now requiring a formal clearance, or more like it would if you're going from the US to Canada or something like that, requires classification. And we do business with some of the biggest marketplaces and platforms in the world, and everyone's scrambling to become compliant and to make sure that the classifications are correct and that they're submitting the correct information to government. So you can imagine if the biggest platforms and marketplaces are struggling and scrambling, well, I wouldn't say struggling, but they're scrambling because of the timing to be compliant and to make sure they're doing the right thing. You can imagine how hard it is on the given retailer to do it.
Now there's other hidden costs coming out of the Brexit stuff as well. So for EU merchants shipping product into the UK, that the payment processing costs that they charge or that get charged are going significantly up here, coming up in October. The EU regulates the interchange rates, which is the cost that you pay for a Visa and MasterCard transaction. After Brexit, that regulation goes away, and so now in the UK they're able to charge more for those same Visa and MasterCard transactions, sometimes up to about 5 times more than what you were paying before. So more and more things are going to keep coming out of the Brexit change that you have to worry about as a global merchant.
Yeah.
So let's talk a little bit about fulfillment. Obviously, you have to get the products, unless you're selling digital products. If you're selling tangible goods, you got to get them there. What sort of advice do you have about fulfillment and free shipping? Eric, do you want to start on that?
Yeah, I think it feels like transparency seems like the word of the day today, and so I think the same thing on the fulfillment side. Having those customers know what they're paying, when they expect that product to get in. Amazon's really set the bar on timing for how long it takes to get a product, and but more importantly, how you track that product and know where it is and when you're gonna be purchasing it. So the more you can show that customer up front how long it's going to take for a product to get from point A to point B, and then provide the services to allow them to track that product is really important. I like to reference my 13-year-old who does more online shopping than he probably should. But of course, just the world he grew up in with me in the household. But he loves kind of gamifying the fulfillment side of things. He loves watching where the product is coming from, when it goes from warehouse A to warehouse B, and he just kind of geeks out on those kinds of things. And I think more and more customers are using those tools, or are used to using those tools to know where their product is. So becoming more and more important in the cross-border world too, especially when shipment times could be longer than what customers may be used to in their domestic world. So being able to log on, be able to see the product has left warehouse A, it's getting to warehouse B. Those types of tools are really important as you improve your experience around fulfillment.
Yeah, I think those are great points. What I'd add to that is, kind of referencing, I've seen the evolution of this business and cross-border e-commerce, and what I would say is it's a good time to be shipping cross-border, because the fulfillment options are significantly better than they were in the past, and getting better all the time. So everyone knows the big three carriers, but there's many other companies that specialize in cross-border e-commerce and leverage local carriers and have expedited brokerage arrangements and other things specifically for e-commerce. So it's a good time to be doing this business, because there's a lot of good options out there. And from our perspective, we like to kind of remain agnostic to the carrier solution. So I think for a retailer, select the right carrier solution for you. And there's a lot of good options out there depending on the types of goods you have and the countries you're shipping to. And then you can still get the duty and tax overlay. You can still get item classification done for your fulfillment partner, and look for solutions that kind of work together, so that you're not kind of stuck with one thing, but you can optimize your supply chain by market for your products by cost, instead of kind of doing an all-in-one solution, is typically what we recommend anyway.
Do you guys see many of your clients offering free shipping to international customers? And if they do, is there like a typical threshold of how much the order has to be?
Yeah, I mean, it's really category dependent, right? Because a lot of folks just don't have the margin room for it, depending on what they're shipping. So you're shipping large plastic toys to Australia, you're probably not going to be offering free shipping. if you're sending a lady's ring that costs $1,000, then you can probably afford to offer free shipping. So if you can do it, anything you can do to lower the non-product fulfillment and extra cost is always an advantage, because it'll increase conversion. But again, it goes back to understanding your costs, understanding your P&L, making sure you have the data that allows you to make good decisions.
Eric, I know that Digital River is a specialist in payments. So why don't you talk a little bit about the importance of offering local payment methods and also local payment processing to retailers doing business cross-border?
Yeah, this point really hits home when you start to talk about how you want a consumer to feel like it's a local experience, even though they're shopping with somebody that may not be in country. And consumers are used to paying the way consumers are used to paying, right? And so being able to allow those consumers to use the payment method that matters most to them, or that they use in their everyday life, really will help conversion. There's countries like Netherlands where consumers use the Ideal network to make payments for all of their utility bills, basically every bill that they have on a recurring basis, or in their everyday lives. And being able to offer that on a checkout experience just pops to them that, oh, I trust this payment method. I'm going to use this payment method, and I don't have to worry about other options or who I'm giving my information to. And then in countries like, for example, Germany, where customers don't like to carry a credit balance, and they don't really enjoy using credit cards as much as we do here in the US, right? Being able to offer them the ability to pay directly from their bank for a transaction versus having to put that on a credit card is very important. So every country really has its own kind of unique payment kind of networks or payment intricacies that you have to think about to really optimize that solution. And then the second part of your question about processing that transaction locally is important from a merchant perspective as well. When you think about the way the credit card networks work and the fraud controls that those credit card companies have, when you're entering a credit card online, that transaction is going back to the bank that issued that card, and they're actually making the decision on am I going to extend the credit for this particular transaction or not. So that happens on a transaction by transaction basis in the background. And those fraud models really look at the transactions and where those transactions are clearing through to determine, are they going to allow that transaction to go through or not. So if you are shipping to somebody that's in Australia, being able to be partnered with a local bank in Australia to clear that transaction through as the merchant allows you to increase your authorization rate. We've seen like 10% increase in approval rates by being able to process those transactions through those networks. So the more local you can make that experience, the better it's going to be. And the more you can kind of hit on what that consumer feels and knows is going to make it a better experience for them. And then I think the last point, which is becoming more and more apparent in some of the stats you showed around young consumers really doing more cross-border sales, also speaks to young consumers like to buy things on installment plans or buy now, pay later plans. And you're starting to see a lot of those types of companies pop up in the space. Companies like Klarna, PayPal offers it with their PayPal credit offering, and those are just two of many that are out there. Being able to offer those payment methods to allow customers to be able to buy a product that they maybe can't afford or don't think they can afford, but it feels good to be able to pay $1,000 at $250 a time, increases the amount that the customer is going to pay and the likelihood that they're going to pay for that particular transaction. So all of those things need to kind of go into account when you're figuring out your overall global payment strategy, who you're going to partner with, how you're going to manage those solutions. And then other simple things like making sure that you're pricing in the currency that the consumer is used to shopping in also become really important.
Yeah, that point about if you don't use a local bank, the banks are likely to turn down more transactions. Something I hadn't realized until I did some of this research in conjunction with Avalara.
Yeah, it's kind of a little hidden secret, but you don't. If you look at the P&Ls of Visa and MasterCard, a lot of their revenue comes from cross-border sales, and so they're always working on ways to optimize those solutions.
So another thing that's changing, obviously, there are treaties related to international trade. Obviously, NAFTA has been updated with a new treaty involving the United States, Canada, and Mexico, and there are other treaties between other countries. Craig, can you talk a little bit about how this is impacting cross-border e-commerce?
Sure. I think there's a little bit of misinformation out there about leveraging treaties. So, in general, what it means is that if there's a treaty rate that you can take advantage of, then you should obviously do so. And what that means is that the country of origin of the product, meaning where it's made, has some kind of preferential rate attached to it for the country it's going to. And what most people don't know, though, is that you have to be able to prove that. So if you're a third-party retailer who buys goods from somewhere, and let's say it's made in the United States, and you're selling to Canada, you need to be able to prove that it was made in the United States. Typically, the government could ask for that at customs. But there are larger retailers and other retailers who make their own goods, even smaller retailers who make their own goods. So if you can take advantage of a treaty rate, you should, and you should know what treaty rates you can take advantage of, depending on where your goods are made and where you're selling them to. So it could be an advantage, but don't take the advantage lightly if you can't prove it, I guess is how I would sum it up.
Eric, do you come across any of this in your world?
Yeah, this is where we like to rely on our partners and our experts like Avalara to really help us get through some of these complexities. So Craig answered it.
Okay, great. Okay, well, we're going to move on to take some questions from the audience. Before we do, I want to announce the winners of our $100 Amazon gift cards. They are Marcin Bosaki and Simbiat Kahinda. So congratulations to the two of you, and a member of our staff will be in touch with you about how you can get your gift cards. So good for you. Okay, so let's move on to some of the questions. Craig, a question about the tariff codes that you made reference to. Can I use the same tariff code that I use to export my products out of the U.S. to import from other countries?
Short answer is no. You can't use the exact same code, but the first six digits are usually relevant. So if it's been classified for export, then the first six digits are probably useful. Although export is typically for, if we're talking, I'm just saying in general for any country, but if you're talking about the US specifically, then it's usually a Schedule B that is used for export, which is different than the HS code nomenclature. So that would be less relevant. But just the code play in general is, you know, the 6-digit code that you may get, or a code you may get from one country, is relevant or, you know, helpful for another country. You know, for example, for our solutions, we used artificial intelligence engines. Part of the inputs can be the 6-digit code that's used for another country. That's helpful information, but it's not sort of going to get you all the information you require.
So next question is, what determines if there is a custom duty owed? Is there a threshold, or is it some other factor?
Yeah, there is a Yep. There is a threshold. It's called de minimis, and each country has its own de minimis level. So, and that's for duty. So also important is that tax and duty thresholds are not always the same. So you could have a $0 de minimis for import VAT, for example, and another threshold for duty that's typically higher. So what determines if the customs duty are owed is there's a threshold, and then how much customs duty you pay is dependent on the type of good, which we talked about, the HS, we call them HS codes, but it's the import classification code. What type of good it is, and then, you know, what type of rate it is, whether it's most favored nation or there's a treaty rate, typically it's most favored nation, would dictate the duty rate. And then the VAT rules are different. They depend on, you know, what country you're going into and what their VAT regime is.
And what happens if a customer rejects the product, says on delivery, says, oh, I don't want to pay the customs duty? What happens then?
Nothing good happens. So this is what happens when you use what I call the fire and forget method, where I've seen customers just hook up to a common carrier and say, hey, I'm just going to ship my stuff. I'll let them worry about it. And their customer on the other end, I live in Canada, so I've experienced this many times, gets a bill at the door for $35, $50 that they weren't expecting. I'm expecting it because I know the industry, and it even annoys me. So when that happens and they reject the good, the carrier is going to bring it back to you, or you're going to ask you what to do with it, whether you want to ship it back. It's going to cost you money to ship it back. Your customer is going to be annoyed, and you're going to end up spending a lot of money on something that and generating a big loss on something that I'm not sure how much, you know, margin you have to play with, but you're going to have to sell a lot more goods in order to make up for that one loss. So shipping DDU, as I mentioned before, which generates this problem, is okay if you set the expectation up front. So just make sure you're giving your customers good information and don't surprise them. And
DDU is when the customer pays upon delivery rather than retailer picking up at checkout, right?
Yeah.
Eric, anything from your side on this?
Yeah, I think it goes back to that customer experience. If you can avoid that and build it into the product price or build it into your checkout experience so the customer can pay for that at checkout, that's a much better customer experience. But like Craig, I think, explained earlier, if you can't do that, you have to at least make sure the customer knows that it's coming. Otherwise, surprises are never a good thing.
Okay, so now we have a rather long question, so I'll try to summarize it. Scott asks, I understand that the UK requires US online sellers to collect VAT on orders less than 135 pounds in value, unless the buyer claims that they are VAT registered. Can the seller just accept that claim? Do they have to substantiate it? Is the buyer required to provide some kind of documentation, such as similar to a sales tax exemption? And can the seller query an online VAT registration database? So, complicated question about the selling into the UK. Craig, do you have any thoughts on that?
Yeah, it's there's a lot of complications when selling into the UK. Typically, what we see is not where UK buyer is declaring that they're VAT registered, which Scott, I believe it is, correctly said that you have to collect VAT at point of sale for less than 135 pounds in value. I don't know offhand, I'll be honest. In this case, if the buyer is saying they're VAT registered, which would be more of a B2B type of transaction, what we see typically is a B2C transaction. This sounds like a B2B transaction because if the buyer is doing that, they're going to be trying to, I would assume, get a file for a VAT rebate. So, that one I would encourage Scott maybe to reach out to us. We have UK VAT experts who can dive into the depths of that question. But on its surface, I don't think there's a way you can automatically do it, from what I know. But we have experts on our staff that know much more than I do, so would encourage Scott to reach out to us directly.
Yeah, it does bring up a good point for merchants to understand, is that more and more business to business shoppers act like a business to consumer sale. So you've got your dentist shop or whatever that's coming on and purchasing as if they're going through that same experience as a consumer would, and they are going to want to be able to enter their VAT number to be able to get VAT exempt, and so being able to do that up front and early in the experience and be able to zero rate that VAT because they've got a valid VAT exemption is important for those smaller B2B shoppers that aren't buying in a typical B2B world where they're buying on purchase order or something like that.
B2B is obviously business to business, so we're talking about small businesses buying from retail websites. Next question, what are the typical tax, customs, and duty challenges that merchants face when working with international fulfillment providers? Craig, do you want to start on that?
Sure, I'll take a crack at this one. First of all, this is a great question because a lot of folks are shipping internationally and not really understanding what their cost position is. So what I see as the big challenges that can happen are a mismatch between what's happening on the ground and in your supply chain and what you think is happening. So, unless you're making sure that the classification that you get or that you have and you own that is what is driving your duty and tax, or duty primarily calculation, but you have a duty and tax calculation that's driven by information that you have that you're then giving to your supply chain partner that is using the same information to clear the goods. In theory, that should all work very well. Where I see folks get into problems is when those two things are divorced. So the carriers are determining the import codes, they're calculating duty and taxes themselves. There can be out of area surcharges. There can all kinds of things can be going on the P&L side with the fulfillment provider that the merchant's not aware of, and then they're upside down on costs on their international fulfillments and they don't know why. So this really comes back to having good information, good data, and then working with partners that can talk to each other, that understand the same things. But you own the information, you own the data, and you're making sure that the data is being managed correctly through your supply chain is how you get your P&L working properly.
Okay, we got another question from the audience. I think this is an important one. When selling products cross-border, can we get into trouble for declaring the product's wholesale value rather than what the customer paid us for it?
I can take, sorry, I feel like I'm monopolizing time here, but so the short answer is yes. So the government's going to be looking for what the customer paid. And typically if it's CIF, then, which is an Incoterm, meaning your cost including insurance and freight, then the cost is what the customer paid plus any cost they paid to get it there is what they're looking at as the input cost for duties and taxes. So yeah, one sure way to get things held in customs is if you're declaring a different value than what the customer paid, or you could see on a website. And we see that happen all the time, where customs agencies actually go and look at websites, and because they look on the website, it's a different value. That's a guaranteed way to get things stuck in customs. So again, the two ways to get things stuck in customs: misdeclare the value, misdeclare what the type of good is.
And Craig, trouble in that case means product stuck in customs, right? It's not like somebody's coming after you, right?
Yeah, no, typically for a B2C transaction, it would just be getting stuck in customs, and then you'll be probably assessed a higher level of duty and tax than, and if you use the wholesale price to charge your customer, then you're going to be out on that side too, depending on how you did it.
Okay, well, we're almost at the top of the hour, so I'm going to wrap this up. I want to thank Craig Reed and Eric of Avalara, Eric Christensen of Digital River. Very interesting stuff. Obviously, a lot of tough questions, but it seems like there are answers if you've got the right information, so that's really good to know. I just want to say before we close that there will be a replay of the webinar available. After we conclude, you'll see a pop-up on the screen asking you for your feedback, which we appreciate if you would take the brief survey because it helps us plan future webinars, and also be on the lookout for our weekly email that lists upcoming Digital Commerce 360 webinars. So thanks you all for attending, and thanks again to Craig Reed and Eric Christensen. It's been an interesting discussion. This is Don Davis from Digital Commerce 360 signing off, and have a great rest of your day.
Thanks, everybody.
Thank you.